ASML warning about growth. ASML, a very key player when it comes to making chips for NVIDIA and a whole bunch of other players. What does that say to you about this tech trade that we all, I think a lot of people felt was kind of shored up yesterday by NVIDIA?
Yeah, I think, what we're seeing right now, of course, we're going to see some short-term ebb and flows in terms of what's happening with the supply chain. But by and large, the story remains one driven by artificial intelligence, and it's here to stay, right? We know that AI is going to have profound changes in the economy next 15 to 20 years, and we're still in the very early days. So we're seeing ebb and flows, but NVIDIA continues to penetrate the market. They have a huge growth opportunity ahead of them, and so we think it's here to stay.
A lot of discussion about exactly how to view tech. Is it growth? Is it safety? Is it possibly both? I want to play a soundbite from Gene Munster, very notable tech voice on our air last night.
The fact that China is willing to use NVIDIA, their junior varsity chips, as a key negotiating piece, the fact that they're willing to accept that, I think really underscores two things. Number one is that U.S. has a substantial lead when it comes to the hardware side. And second is that they recognize the power of AI is going to be so important that they need to take anything that they can.
So I know you can't talk specific stocks, but we're talking NVIDIA, other U.S. hardware players. Is this kind of demand from China, is it priced in? Because remember back earlier this year, there was DeepSeek, and it kind of shook people up about the need for hardware and infrastructure. But it seems pretty clear that China feels like they need U.S. companies' infrastructure and hardware. Yeah,
look, Gene is right. The U.S. has a huge lead when it comes to this technology. And for right now, China is playing catch up. So I think we are going to see continued demand to the extent that China continues to have access. That's going to remain an open question because we've seen a back and forth on that. But for right now, the U.S. companies have a clear lead in this technology, and we're going to continue to see global demand.
Does that maintain tech as a safety trade because there might be growth that's not priced in? Is it growth? I mean, kind of give me a sense. How do you view tech right now? And again, tech was the only sector in the green yesterday.
Yeah, look, Frank, it's a little bit of all the above, right? We know that we're seeing above market trends as far as the growth rate is concerned. Investors certainly appreciate the predictability and the safety of that. And look, by and large, these companies have best-in-class profit margins and cash flows. And to the extent that that remains, that really provides stability and clarity for investors moving forward.
I got to talk to you about bonds as well, but very quickly. When talking to alternative asset managers, the KKRs, the Ares, et cetera, of the world, with the idea the president's going to sign an executive order allowing more private investments in 401ks, does that change your view on those names?
Well, look, there's $12.5 trillion of assets sitting in 401ks. So even a small penetration of that is meaningful flows for the alternative asset managers. I think the one thing to keep an eye on is with changes in the capital regime, do the banks, the big banks who've largely ceded this market to the KKRs of the world, do they start to edge back in?
We're going to talk about that later in the show. You're front running us, Nick. You're front running us. We're going to talk about that in a second.
You got it.
Got to talk to you about bonds. We hit it earlier. The 30-year above 5%. In your mind, is that a warning signal or is it maybe an opportunity with yields moving that high and also the 2-year very close to 4%?
Yeah, I don't think we're quite there yet in terms of an a warning signal, but it certainly is something you want to keep an eye on, right? As rates start to go higher, of course, the discount rate goes higher, and that potentially puts pressures on stocks in the short term. But I would really keep an eye on the 10-year. We've seen the 10-year has oscillated in this range, 4.5%, 4.75%.
Is there a level where it becomes a warning signal when we're talking about the benchmark, the 10-year?
Yeah, I think when we're looking at the 10-year, anything above sort of the 4.8%, 4.9%, I think you definitely have to stop and reassess what's going on and why it's going higher. But for right now, we seem to be in this trading range that we've been in for quite some time.